First part. Very good morning, everyone. Welcome to our weekly market outlook. Today we have three things on the agenda. The first part would be actually the macro and market outlook, followed by a featured company, which is NOL, and lastly we'll be updating on the recent impact of the property sector. With regard to the macro and market outlook, in summary, we're actually constructive on the 2013 investment outlook. So specifically, in terms of global macro fundamentals, it's turning positive in the US, China, less negative in Eurozone, and resilient in ASEAN. Synchronized monetary easing by the G4 central banks will ensure that downside support for risk assets, particularly equities. But we caution that downside risk remains, largely from sharper than expected fiscal drag in US Eurozone, China's growth faltering, and a premature exit by the Fed. Through the near term, markets could actually pull back amid lingering uncertainties over unresolved issues on the US and Eurozone front. But we like to highlight that such pullback in prices actually serve as an attractive opportunity to enter long positions or accumulate overweights on China, Hong Kong on compelling valuations, as well as Philippines, Singapore, and Thailand equities. Our Singapore equity strategies top picks are actually SIAEC, CapitaLand, and Pan United. In terms of data preview, so for this week for Singapore, Nordex data will actually be released. We're expecting weakness in electronics manufacturing output as well as exports to actually persist in the near term, because as compared to our Northeast Asian partners, Singapore is actually not plugged into the tablet and smartphone value chain. Furthermore, global demand, as reflected by our semi-book-to-bill, remains tepid, but we should point out that there could be actually a cyclical upturn in the electronics sector in the second half of this year. For the STI, markets actually gapped down when they opened this today. Property counters might see a knee-jerk reaction from the latest round of cooling measures. Once again, pullbacks actually offer an opportunity to enter long or accumulate preferred stock picks, such as SIAEC, CapitaLand, and Pan United.
Alright, good morning everyone. This is Derek, Singapore Equity Strategist. I'll provide some research updates for this week. On 9th of January, our analyst actually updated his model and raised his target price on Singapore Exchange from 677 to 685 and maintained his neutral recommendation of the stock. We provided some property sector updates today, which will be elaborated further later in the presentation. We also updated on SC Global. We see that there's decreasing public flow on the stock. And we don't think that there is likely to be a counter offer at a higher price, so we recommend that investors accept the offer or sell in the open market if they can sell at a higher price. Biosenses, we wrote a non-written note on this company, which you can take a look from poems. Alright, so these are the preferred stocks in the various sector. For the commodities and supply chain managers, we prefer Golden Agri over Wilmar, which is the other stock that we cover in this sector. Among the banking stocks, we still prefer UOB. Developers, we prefer CapitaLand. And for REITs, we like Parkway Life REIT. For the industrials, capital goods and transportation sector, we have quite a few names there: SI Engineering, Kappa Corp, and Pan United. And for the cyclical plays, we actually have a positive view on SIA and NOL. Within the telco space, we continue to prefer StarHub over the other two telcos. Alright, now for the featured company this week, we are talking about NOL. NOL's container shipping line, APL, is actually the 7th largest carrier in the world. It derives half of the revenue from America, as you can see from this chart over here in the top right hand corner. This is the liner revenue spread in this year, previous year actually, sorry. So with that, they are very sensitive to the economic conditions in the US. They also have APL Logistics, which is a logistic arms for the group, but it's a consistent performer, but usually not a share price driver on the stock. Next, let's just take a look at the history of the shipping line. Shipping is a highly cyclical business. As you can see over here, prior to the global financial crisis, profits were very strong and then led to huge orders for vessels by the industry. In 2009, I'm sure everyone is aware that the demand for shipping services collapsed as the global financial crisis deepened. In 2010, there was a strong upturn as the restocking trade actually drove profits for NOL higher. But this was short-lived as the deliveries for vessels that were ordered prior to the global financial crisis pressured the freight rates and drove NOL to another year in the red in 2011. Let's take a look at the stock price history. It's a pretty bumpy ride for investors. So I took over coverage on this stock in July 2011. We downgraded the stock at the time because freight rates were under quite a bit of pressure, and the market participants were very focused on the capex cash drag on the shipping line for the new vessels, and coupled with the fact that 2011 is likely to be another year of losses prior as compared to the strong profits in the prior year, the stock continued to tank. But in October 2011, the stock price of this stock actually reached a point whereby we think that the risk-reward trade-off is pretty skewed, as the valuations are already in recession territory. So we upgraded the stock to a buy at the time. As you can see, it's pretty low in the chart at that time. In March, February 2012, there were quite a few series of rate hikes proposed by various industry players, as well as Maersk, the largest container shipping line in the world. So the markets continue to rally, continue to turn positive on the stock, and the stock rallied in enthusiasm over these proposed rate hikes. But we took a bit more contrarian view on this rate hikes actually, because we think that the rates hikes will actually be offset by the then very high bunker prices in the fuel market. So we downgrade our recommendation then. So now in October 2012, we upgraded NOL to accumulate. So why do we turn positive now? Let's take a look at the reasons why. The first reason, unit cost has declined sequentially, and NOL actually turned profitable in the third quarter with profits of 50 million. As you can see in the top right hand corner chart here, after quite a few quarters of losses. And unit slot cost, this red line over here, has declined sequentially despite the very high bunker prices. And the ongoing streamlining exercise by the group actually saved them $360 million year to date. Going forward, we think that the delivery of these huge vessels that were ordered around the past few years will actually improve the cost competitiveness of NOL through economies of scale and better fuel efficiency, etc. So we see this as a downtrend as something that will be here to stay. The second reason, I'm sure most of you will be aware, NOL actually sold off their building at Alexandria Road to Fragrance Group. The transaction price is $380 million, marginally above initial market expectations of $350 million. This divestment is scheduled for completion sometime next month. So why are we positive on this? Because we believe that NOL's high leverage is actually a source of investor concerns. So through the sale of this building, its leverage would be improved, and the stress on its balance sheet would be lower. The third reason to buy NOL, APL, the NOL's container shipping line, is actually a major player on the Trans-Pacific trade. It's highly sensitive to economic conditions in the US, which arguably is a brighter spot among the major economies. And you can see over here, this is a chart of the housing markets in the US. It's actually exhibited an uptrend and recovered sequentially over the past few months. What's the impact of a recovery in the US housing market? The first of which is that it has been a key weakness over the past few years on the US economy. So a recovery in this sector is definitely some positive indicators for the US economy. And second reason, more specific to this trade, to the containerized trade business, is that it will lead to higher demand for containerized goods such as like furniture products, etc. The fourth reason, perhaps we could be seeing some turning point in the trade cycles. If you look at the PMI data that is disclosed in the US and China, it's actually in expansion territory. For the Eurozone side, we are in contraction, but it's turning less negative. On the global PMI disclosed by JP Morgan, that is around 3.7, firmly in expansion territory as well. So if you look at the trade data at the various ports, it has contracted for most of 2012. And if you look at the latest data point from Long Beach, it's actually up in expansion territory. So perhaps we could have seen the worst in the the port volumes. So possibly highlighting a turning point in the trade indicators. Fifth reason, I mentioned at the start of this presentation that the high orders for all these container ships are actually a drag on the freight rates. As a result, over the past few years, freight rates has been collapsing. So now we have seen the order book actually easing off to a level that is lower than the pre-crisis levels. So that means that future deliveries and pressure on the supply-demand side would be eased off. And if you look at the latest commentaries by Maersk, the world's largest shipping line, they actually highlighted that they intend to shift their investments away from the container shipping business to other areas. While this is a fairly unique situation to this conglomerate, it does indicate that caution has actually returned to the industry. The final reason for why we think we could consider buying NOL is because of the Resolute buying the liners. There's been alliances on the most troubled Asia to Europe trade lanes. And having this alliance, a few groups here, we have Maersk Line, CMA CGM collaborating with MSC, CKYH Alliance, and finally G6 Alliance, where APL is part of. All these alliances would actually hold back the supply on these trade lanes and prevent a full collapse of these freight rates. With this chart over here, you can see the blue line actually highlights the spot rates on the Shanghai Shipping Exchange. The red ones are the contractual rates. The spot rates are very volatile, and in the latest weekly data that was disclosed, it actually jumped around 7%. This further validates our view that the rates have actually stabilized in the container shipping industry. And the most important thing is that the liner industry is really too financially stressed to compete irrationally anymore. Well, but please do not expect a strong rebound in this stock. I don't think it is all clear yet. The oversupply situation still persists. Industry estimates a supply growth of around 7%, which is a floating number that depends on how much scrapping is done this year. And shipyards are really very hungry now, with their emptying out order book, with new built vessels becoming really cheap. So if the shipping lines are tempted by these cheap vessel prices, we could see a return in irrational behavior again. And bunker prices are still high by historical standards, as you can see in this chart over here, still on an elevated level. So for 2013, we expect only a very small profit for NOL, even after stripping out the one-off gain on the sale of the building. The valuations are not excessively cheap, but reasonable as compared to the previous market bottoms and recovery years. It's trading at around 1 times FY13 earnings, and 1 times FY13's book value and 0.9 times FY14's book value, fairly in line with historical recovery trends. There's still upside, but not a lot. So to conclude, I would say that markets are always forward-looking, and NOL, like a lot of major transport companies, are bellwethers for the industry. So in order to trade this stock, please be ahead of the curve and look ahead and not look at historical numbers. End of the day, NOL is a stock to not a stock to buy and hold, but you have to understand the valuation, sentiments, and cycle specific to this counter. All right, I'll hand over to Brian to talk about this property sector update.
Hi, good morning. This is Brian from Phillip Securities. Just an update on the property sectors. The government came out with the 7th round of cooling measures to tame the property prices, and some of the temporary measures which the government will review in future depending on market condition. They are the adjustment to the ABSD rates with 5 to 7 percentage points increase across the board. And for PRs purchasing first residential property and Singaporean purchasing their second residential property, we need to pay for this ABSD now. And the loan to valuation ratio limits are lowered, and also cash down payment required for second or subsequent housing loans is increased to 25% from previously 10%. So all this are engineered to control the liquidity and make the financing more difficult for the second second timer and the investors. And in more temporary, more permanent measures are for the public housing, where the eligibility for loans to buy HDB flats is tightened in terms of lowering down the ratio for loan housing mortgage to gross income of the buyers. And for PRs who now own HDB flats are not allowed to sublet their whole flats. And also PR who want to buy private residential property must sell their HDB flats within 6 months of their purchase. And for the executive condominium, there is a cap now on the maximum size of executive condo with 160 square meter, and the popular units, dual key EC units, will be restricted to multi-generation families only. And also the developers now can only launch their units for sale 15 months from the date of award of the site or after physical completion of foundation. And that means developers will have less flexibility in changing their design scheme, which they used to do to adapt to the market preference. And in terms of the private enclosed spaces and roof terraces, now will be counted as part of their bonus GFA, and these are subject to payment of relevant charges if they want to sell it. And for the first time in the industrial property segment, the government introduced the seller's stamp duty with the rates of 15% to 5% for the industrial properties and land sold within 1 to 3 years of the date of purchase. So with this package of new measures, we believe this could provide some relief to the strong demand for residential property and provide greater distinction for the first timer compared to the second timer, also called investor or PRs. And we do not expect significant correction of residential property prices because we currently Singapore, it's still economy is still not in recession, and we have ample liquidity and low interest rate environment. And with that, we maintain our view that price could correct around 5% in 2013, which is unchanged. And in terms of sales volume, from the figures from our banking analysts, the loan approved for the buyers in last year, there are about 27% of the loans are for investors. So if you consider this a 27% investment to be taken away after this cooling measures, it will be about 1/3 of the total sales volume, about 30%. But we don't expect all this 27% investor to be taken off market, because usually the market will figure out how to go around the policy, and developers could also introduce more promotional package, such as rebates to the buyer, or provide discount to the buyer to attract investors. So we will need to monitor further on the actual effect of these cooling measures. And for our sector topic, we remain unchanged. We like CapitaLand. For this, their diversified portfolio could help in lower down the risk of concentration in a specific sector. So with 1/3 of asset in Singapore and 1/3 of asset in China, and also other than geographical diversification, they are also diversified into the different asset classes of the real estate. So it's not solely concentrated in residential sector, and that's the main reason we continue to like CapitaLand. I'll hand over to our banking analyst. Thanks.
Hi, this is Ken here, the banking analyst. Just a quick update on the banking sector in terms of the impact of the new property cooling measures on the banks. Based on, as touched on by Brian just now, based on MAS preliminary data for Q3 of 2012, we estimate that 27.6% of new housing loans were for investment purposes. This data, however, do not reflect the previous round of cooling measures that were introduced in October 2012. This is due to the long loan approval process, and therefore we will only see more of the cooling measures being felt in second quarter of 2013. Whereas the October cooling measures, you would probably see more effects of those cooling measures in the first quarter of 2013. Based on the respective third quarter results, just to look at the historical figures, UOB and DBS have the largest market share of housing loan at approximately 29.7% of total system loans. System loans consist of both the DBU loans and the ACU loans, while OCBC has a smaller market share at around 24.3%. In terms of the banks itself, housing loans make up the largest proportion of total loans, for UOB at 29.1%, while for DBS and OCBC it would be 21.5% and 25.9% respectively. In terms of the changes, this will not be applied retrospectively. Instead, it will only be applied prospectively. We expect housing loan balances to be relatively stable. However, we expect that a decline might happen in the FY13 loans growth, noting that housing loans were actually one of the main drivers of loans growth. Based on the estimated 29% of 0.7 of loans being for investment purposes, and assuming that 20% of these investors will continue to invest, this will imply a 23.8% decline in previously expected loans growth. For example, a growth forecast of 10% would be revised downward to 7.62 instead. While loans growth may decrease, the further tightening of loan-to-value ratios for individuals with at least one outstanding loan and non-individual borrowers may reduce the attractiveness of refinancing. The pressure on mortgage has actually been has been driving down the NIMs, especially for all three Singapore banks. And with this lower refinancing rate, the NIMs pressure may be relieved, and this may provide some upward even some upward movement for the NIMs, and this will be positive for the banks. We'll be looking at these figures further and presenting a more detailed analysis of the banking sector soon.
Hello. You may ask question by typing in the webinar and send a question over to us. We will try to answer your question. And the first question. Okay, on the question of the residential segment, which market will be most affected by the new measures, and what is the house view on the amount of impact? Okay, our our projection of 5% correction, it's refer to the overall private residential property, and we don't forecast specifically into which region, but for this cooling measure purposes, from the measures introduced, it will be broad-based based on those ABSD and also loan to valuation ratio adjustments. So this will affect all the segments. And for the public and for the so-called the ABSD applicable to the first timer of PR and also second timer for citizen, this will also affect across the segment. But the segment with the higher investment element would be affected the most, and in this case we believe it covers the mass market private residential properties, which is pretty strong in the past 1 years. And for EC wise, I think the regulation is very much to control the developers in how they design the units and plan their sales scheme. So we believe the underlying demand for EC will still be strong, and that's the same for HDB. And yeah, I think and the next question will be on industrial property. Would that be affected as well? And okay, this is the first time the government introduced this measure on the industrial property, and from the experience of the residential sectors, the first when the first the ABSD first introduced to the residential sector, it caused a knee-jerk reaction to the market, but the investment, the buying demand is still strong, and as proven by the previous year sales record, the investor are mostly not deterred by the measures. So for this industrial property segment, we expect a similar impact for the first few months to have knee-jerk reaction, but as the underlying market is still performing well, we expect the buying sentiment to come back in the probably the next quarters. I'll hand on to Ken on the question on banking.
This is Ken here. On the banking sector, currently we are more of a neutral rate. To reiterate, our costs accumulate on UOB, neutral on DBS, and reduce on OCBC. Moving forward, given the drop in price, should price decrease further, it may actually be a good opportunity to invest in the banks. This is because as we have presented, the property cooling measures has actually had positive and negative in terms of negative, that would be the lower loans growth, but at the same time, the positive would be that there'll be less pressure on net interest margins. Furthermore, there are also other catalysts, such as a recovery in the China market, a higher export in the China market, and this would actually help in increasing the fees and commission of the all three banks, especially DBS, whereby they actually have quite a large, they have a more significant exposure in the China market. Also, in 2013, we expect that all three banks would continue to deliver relatively strong growth, sustained growth. Now, for the rates, I'll pass on to Travis.
There's a question on would which sectors be affected as well by the cooling measures. In my view, I think that the industrial REITs will not be much affected because the cooling measures is to impose on the stamp duty. So So for the long-term investors and long-term investors and for the long-term investor and user, they will not be affected by the cooling measures. Yeah. Actually, we think that it's actually positive for REITs because the cooling measures is imposed on the residential. So REITs being seen as alternative investments vehicles, they actually could be a beneficiary from the cooling measures. And investors are looking for alternative investment, they will be looking elsewhere, and this is one of the choice that they can invest on. So any other questions regards to today's presentation? Since there's no more questions, we will end the presentation here. Yeah, thank you.